Hi, everyone. I'm Pamela Hastings, and welcome to another Barometer webcast, along with my fellow relationship managers, Tanya Kramarska, Lori Ouellette, Shavana Persaud, Harrison Baptist, and our new partners, Jim Allen, Jeff Spital, and Peter McCarthy. We welcome you so warmly and are thrilled to have you join us today while we all shelter in place and stay safe. Joining me today is David Burrows, our Chief Investment Strategist at Barometer Capital Management, and James Callahan, one of our investment analysts. During this video conference, we will provide you with current market and economic conditions while we address your questions through an interactive Q&A with David. I've received some questions in advance, but will, as always, encourage questions from participants via the chat or Q&A platform. Please email me at phastings@barometercapital.ca. Of course, if we are unable to address all of your questions, we will follow up with you after the call. With that, I turn the conversation over to David Burrows.
Thanks, Pam. Thanks very much. Thanks everybody for joining today. Obviously, there's lots going on in markets, so we've been doing these weekly. Today was a pretty big day, and certainly worth talking about. This market has been quite news driven, and there has been just a remarkable amount of market making news over the last couple of weeks. As we've talked about, the market had this tremendous decline from the end of February through the end of March. And what I want to do now is just quickly give you a snapshot as to what we're seeing, what is changing, and where we think things are going. And then more importantly, we want to answer some questions. We had a lot of folks send in questions that they want answered. Hopefully some of you on the line have a couple of questions yourselves, and we'll try and do that. The other thing that we're going to do is talk about, because we've been asked, a couple of our sort of favorite ideas going forward, and things that we own that we would continue to buy here, and talk a little bit about that. So just from a market perspective, you know, we talked about the fact at the end of March, we thought we would get a good sized bounce, and then we would see where the market would take us. Our breadth work turned positive at the end of March, giving us a green light that we had at least some period of time where we would get at least a technical bounce in the market. We thought sort of 38 to 50% might be reasonable. It was obviously a very, very difficult and sharp decline. And as always, thank God for stop losses. As the market declined, our stops kind of kicked in. As you guys know, we like to own neighborhoods within the market where over time more and more stocks are participating in a rally or the market is broadening. That is considered healthy. And that is what we are always looking for, whether it's at the market level or whether it's at the sector level or whether it's specific themes. We want to know where money is going, because at the end of the day, all of the various pieces of news are moving parts in the market. The market synthesizes it and people vote with their feet. Now, the thing we don't like to see is deterioration in breadth. And often, early days, the weakest securities sell off first, and then the selling broadens into more and more securities. And that tells us during a period like that, not time to put money to work, time to be very defensive, time to follow our stop losses and not deploy new capital. So we did that through the decline. As we saw breadth deteriorate, as we saw stocks get hit, we wound up reducing our weights quite dramatically. And as you know, when we got to the bottom, our various pools came through the decline quite well, giving up about a half of what the market gave up. So the question is where to from there? Certainly our first job, I thought, was to, because we were in a very volatile market, maintain low volatility in the portfolios. Because this COVID issue, whether or not the disease starts getting better, whether or not we get Fed stimulus and monetary and fiscal policy, there are going to be bumps along the way. There is no market that goes straight up. And so we felt that our first job was to protect on the way down. The second was to participate on a rally. Third was not to get too far out over our skis, because this market is going to be dependent day by day on developments unfolding. So we can only know as much as we know, and then we have to always watch how the market reacts to new news. How is it taking it? How is it going into the calculus of what investors are doing? And then does it cause us to need to make changes to our holdings? So we talked about how in a waterfall decline, often you get, some period where the market chops its way sideways after an initial rally. And of course, in a secular bull market like we've been in, most often a sharp decline, even like the one in 87, is followed by strength, and the market tends to have an ability to recover quite well, but it takes some time. So we saw lows on the 23rd of March. The market has worked its way higher. The first phase was purely a technical bounce. We got oversold. Then the market pulled back a little. And then we had a second phase, and the second phase was driven by a slowdown in the cases of COVID, and also some very significant stimulus coming from central banks and some very significant packages of fiscal policy passed by policymakers in the US and around the world. And then for about 10 days, the market chopped its way sideways. And then today, we had some more news, and the market had another leap. And that's the news that Gilead Sciences therapeutic has come back with some quite good results, which on the surface is just one therapeutic. But when you think about it, when used over a 5 or 10-day course, it looks as though it takes the risk of fatality significantly off the table. So we can deal with disease and discomfort. Fatality is something that we're all afraid of. And so this caused another leap forward in the market today, more news. Now, it's still our premise that as we go along, we are going to be dependent on how long it takes to reopen various parts of the economy, what kind of solvency issues businesses face as we go along. So a longer reopening and a slower trajectory in the lift means that the market will have some bumps. If it goes faster than we expect, the market's going to do a little bit better. Here's what our work is showing us. We talk about the breadth model that we use, where we track the percentage of stocks in any particular universe. In this case, we're looking at the NYSE, where the shares are behaving constructively. We give each company a single vote, and we track daily what percent of securities have clearly defined upward price trends. Knowing that, as I told you, in a healthy market, more and more should be participating, and in a weaker market, one by one, securities sell off. So we saw a low in our breadth model on the 23rd of March, where 6% of NYSE companies had been able to buck the trend, while 94% had been selling off. It was roughly where we bottomed in the NYSE in 2008, where it bottomed at 4%. In 2008, you bottomed in October. The market rallied sharply through January, but then had a second wave of decline. And breadth weakened again into March, where we hit a new low in the market, and then the market rallied from there. So here's what we've seen. We saw breadth turn positive at the end of March. Breadth expanded until 10 days ago. And 10 days ago, we started to see some deterioration under the surface. Some of the weaker sectors, things that would be more economically impacted by this shutdown, started to sell off. People started to lose confidence. The leaders, some of the groups that we've been focused in, like technology and healthcare, maintained their positive bias. Now, we run this model for 41 industry groups, and several industries weaken: financials, transports, industrials, energy, of course. But you can see that as of yesterday, the breadth model reversed back up. So after 10 days of choppiness, enough companies reversed their trend where we're back in a more constructive environment. So for now, the backdrop continues to improve. When we look at the chart of the S&P 500, this is the decline using a point and figure chart, lower lows and lower highs into the bottom. We had the first leg higher, market check back. We had the second leg higher, market check back. But again, yesterday and today, reversing and breaking out to a new high. So again, we re-enter sort of higher highs and higher lows. We have to take that as constructive. If I look at the percentage of companies trading above their 150-day moving average or long-term moving average, as of yesterday, only 12% of companies were in defined uptrends based on a long-term moving average. But where we had a small number of stocks trading above their 50-day moving average, 24%, as of today, we're at 50%. That's very constructive. So the market is going through a healing process. And one by one, companies are joining this rally. The sectors that were leading off the bottom continue to be constructive, but we're seeing a little bit of broadening in the market. So clearly the NASDAQ has been the strength in the market. It's been in a very clear channel since we got off the bottom. A lot of the companies in the NASDAQ are growth companies that are less economically sensitive and have very defendable business models, like, for instance, software as a service where people pay a subscription. And that has been the strength. Healthcare has been strength off the bottom, almost back to highs. So this has been a big spot for us to focus in, and within there are pharmaceutical companies, there are biotech companies, there are healthcare devices companies. Abbott Labs is one of our big holdings. Of course, they've had some good news on their COVID tests. Technology has been leaders, been basically new relative highs versus the market. And here we have software, companies like Microsoft. We have semiconductor companies, obviously having a big day today, up 6%, very close back to highs. You have cloud companies, you have cybersecurity companies, you have plumbing for internet retail. In the consumer, online retail. So these are all groups that have had a tailwind going through this process where, in fact, adoption of their new key services may be sped up. So, of course, Amazon, after spending all the money on their one-day delivery, moving people further along into online retail. Gaming, very, very popular. In utilities, some of the growthy utilities like Nextera has been performing really well. The golds, of course, have been a big area of leadership in the market. There's Newmont, and there's Franco-Nevada. So we think that a lot of these groups have a long way to go, and there certainly will be pullbacks. In the case of gold and silver, they've had a great rally, but frankly, only halfway back to where they were in 2010, even though gold is at a new all-time high. Again, probably legs in front of us. Now, the big news today was Gilead Sciences. And Gilead Sciences came out to tell us that in one of the major studies that's being done, the results against a double-blind test show that Gilead has a significant impact on survivability in the COVID virus. And that lit a fire under some of the groups that would be most hurt if the shutdown went on longer. So groups that have not participated in the rally, for instance, banks, languished around the lows. In the last 3 days, 1, 2, 3 very big days, banks up 7% today. Now, that is the group that is at most risk if there is insolvencies or if there are bad loans. But today, this made a big difference. It brought the banks into the rally. So we'll have to see whether that's something that's sustainable. Industrials, after meandering initial lift and then meandering sideways, while the rest of the market was strengthening, got a big lift today, up 2.5%, joining the rally. And even though that they had been relative to the market, the weakest group, you've seen some relative improvement. Market broadened today into transports. Again, one of the groups that's been most hurt. Leisure and entertainment. This includes the hotel companies, the cruise lines, and the airlines. Very, very weak, and a lift in the last 2 days, joining the rally. And then, of course, energy. And energy has been very, very weak on weak energy prices. But again, big moves today. The group up 15%. Sorry, CNQ, one of our holdings, up 15% today. Again, we have to see whether this is going to be sustainable. The positive is that when we take all of the sectors here in capital letters, computers, textiles, which is apparel, electronics, builders, business services, healthcare, they all are showing improvement on our breadth models. The ones in red are groups that just today have turned up. Savings and loans, that's regional banks, financial services companies, insurance companies, banks, transports, real estate investment trusts. These are groups that had been weak, have joined the rally today. So some groups that have not joined. Oil and gas has not given us a buy in our breadthwork, steel companies not, aerospace not, electric utilities. So then the message is that things are improving. And it's not our job to second guess whether this should happen. It's that it is happening. We still think that we're in a secular bull market in stocks. We've been able to hold this uptrend that we've been in since 2013, market rallying back quite nicely. Just about 60% of the decline has been recaptured. And in the NASDAQ, similar, very, very strong, stayed within long-term trends. So we continue to think this is a shorter term issue in a long-term bull market. So as you know, we've been invested. We've been focused in secular growth companies, themes that are structurally benefiting from what's going on. We've been in some of the defensive sectors that are less economically sensitive, but where we're getting paid good dividends. We have had a little bit of cash, not a lot, that we've been holding back for opportunity for new sectors to turn higher. I'm encouraged by what happened today, but I think that ultimately we're still going to take time. There are going to be good days and there are going to be bad days, but this was another step forward today. So from our standpoint, we have to continue to run our models. We have to continue to use our stop losses. If themes that we're focused in start to fail, we would move aside. But I will tell you, internally, investors are digesting the news, assessing what they think is the risk going forward, and they are voting with their feet to put money to work.
Why don't we begin, Dave? You touched a little bit on the current rally, so I wouldn't mind just following up with that and asking a couple of questions. So first and foremost, what clues might you be watching for to point to an extension of the current rally?
Okay, so realistically, the rally up to this point has been a very narrow rally. So if you were to look at it, a major part of the advance has been in the top 5 or 6 stocks. If you take the FANG stocks, effectively the 6 largest ones, they now make up 23% of the S&P 500, which is actually significantly more than the top stocks did in the tech boom in the late 1990s. So it's been important. They have been leadership in the market, as we've seen. Amazon's been very strong, lots of others. What we need to see is for the rally to continue to broaden out. So the last 2 or 3 days are a question mark. Because when the market's had a strong rally, and then after a while, a few of the real laggards kick in, it can be short-lived. So we need to see if this bounce in the last couple of days in the financials and the industrials and the small cap stocks is something that can last. And that's a question mark, but that's something that we're watching for. I watch for, are there more sectors joining the rally? Now, one thing I can say, and I said this in the last call, is that when energy prices, oil prices went to new lows, and in fact went negative, oil stocks didn't go back to new lows. And in fact, some of the large ones started to outperform the market. So that is very constructive. That tells us that things are getting a little bit better. So those are the types of things that we're watching for. Now, sadly, in the last 2 or 3 days, as you know, we don't buy the junk. We don't buy the things that have lagged. So this rally today is a little bit painful because the biggest moves have been in the absolute weakest stocks. Yesterday, the top 10 stocks in the market were like 10 of the worst performing stocks in the year. The average was that they were each down an average of 44%. So we want to see if this broadening can hold. That would be the biggest thing.
Dave, on that note, you talked about the fact that Barometer portfolios are not trying to be in all areas of the market. Can you name 2 or 3 companies that are representative of strong themes that you think are well suited to the current environment?
Sure, and I'd be happy to do that. And I asked James to jump on the line. James, for those that don't know James Callahan, he's one of our key analysts. He does a lot of work on the U.S. companies. I thought that I could put up a couple. and give you thoughts as to why I think that they have legs. And then maybe James can throw a little extra meat on the bone. But, you know, clearly if I had to pick one stock, I probably would pick Amazon as one of those, as that company. If you look at it just from a business perspective, we've moved into a market and an economy that in many industries, it's become winner take all. And Amazon clearly has built a dominant spot in online retail. Interestingly, over the last year and a half, the stock went sideways while they went through a major upgrade cycle of their distribution system so that they could go to one-day delivery. And that probably couldn't have happened at a better time. They hired hundreds of thousands of new employees. And they're at the other side here, and they've been handling their volumes quite well. And in particular, I think that they are signing up a ton of new Prime subscribers who just pay them a subscription fee every month. They also have a pretty dominant cloud business. But James, are you there? Could you maybe make a couple of comments?
Yeah, I am.
On the metrics?
Thanks, Dave. So we're going to know more tomorrow afternoon when Amazon reports Q1 earnings. So we'll have better visibility then. Right now, it's tough to say exactly what they're going to report for the e-commerce business. It's likely going to be very strong, even with some lost sales due to product delays. Expectations are for them to grow the North American retail business more than 20%, which is on a huge base already. What we do know is that, you know, they are going absolutely flat out to try and fulfill orders. In the month of March in North America, they hired 100,000 workers, and in April they've hired another 75,000. So that right there indicates explosive demand. And as Dave mentioned, what we know for sure is that, you know, going forward, brick and mortar retailers are going to be structurally challenged. Less people want to be out in public, much less in a crowded store. And then the cloud piece as well. So AWS, which is Amazon Web Services, it's about 13% of revenue, but it's growing at an explosive rate. It's growing over 50% year over year. And given the results we just saw so Microsoft just reported their first quarter earnings, their cloud service, Azure, grew over 60% year over year. So with that as a read through into AWS, AWS is going to put up a very strong quarter as well, just as companies continue to move workload to the cloud at a more rapid pace now, just given what's been going on. So yeah, and as Dave mentioned, this is playing out as Amazon comes out of an investment cycle, which historically has been a great time to get in.
So just to play on that for a second, what I want to do is just talk about why this fits what we do. Okay, our strategy is find companies that are winning to begin with, where we are seeing acceleration in their underlying businesses, and we are not dependent on conditions getting better. So if this thing went on for a long time, Amazon is only going to increase their lead over their competition. So some would say that move to online retail has been moved forward by 2 to 3 years in the changed behavior that people have put up in the last few weeks, and this will only benefit Amazon going forward. So maybe I'll jump to another name. I guess staying in the tech theme, I would stick with an NVIDIA. Oh, the lights just went back on. My power came back. So NVIDIA would be another company that I would touch on as being one of those disruptor companies benefiting from major structural changes. You know, just from a price standpoint, we spent about a year and a half chopping way sideways while they upgraded the business and opened up some new spaces. They're significant players in artificial intelligence and machine learning, which, as we know, is growing in leaps and bounds. They are a significant player in the gaming market. Certainly lots of people stuck at home playing video games. And also a major player in autonomous driving as it comes along. James, do you want to touch on that quickly?
Yeah, absolutely. So NVIDIA is one of our highest conviction ideas, and it really has been for some time. I won't get too into the weeds on the tech, but NVIDIA sits in the semiconductor industry. They make the best GPUs, so graphics processing units. They sell these GPUs into 3 end markets, all of which have very strong secular tailwinds. So 50% of revenue comes from GPU sales for gaming. So if you want to build a high-end, powerful PC that you're going to use for gaming, you really need to buy an NVIDIA GPU. Gaming is a secular theme that we favored over the past few years, and the fact is that more people are playing more video games, and as the base of PC gamers grow, NVIDIA's done a fantastic job of defending their market share, and they should continue to benefit. So that gaming segment is, they're growing that business about 15% year over year, which is huge. And then 25% of revenue comes from sales of GPUs into data centers. This is probably most relevant right now, just given the pace at which we're seeing hyperscale cloud providers like Amazon and Microsoft build out capacity. So NVIDIA grew this piece of the business by over 50% last year. And now with the tailwind from COVID, they're going to put up big numbers here. So as you can imagine, these cloud service providers fight for as much throughput as possible. And a few years ago, they figured out that by adding GPUs to the server stacks, they could really increase the ability of that server stack to process data. So since then, GPUs have been an integral part of the way that data centers are structured. And while GPUs made by a competitor, a company called AMD, might be able to compete with some of the lower end PC gaming GPUs, there's really nobody that can compete in the high end space. So they really have the data center market cornered. And then the last end market is AI training and graphic design. So that does tie into autonomous driving too. So to train AI systems to recognize objects and to train autonomous cars to recognize objects too, you need a lot of GPU processing power. So they do some business there as well, but perhaps less relevant than cloud and gaming. So I'll leave it there.
Okay. James, I'm going to touch on one more, and I've just changed gears for a second to the financials group. Again, going back to secular themes to move to ETFs, move to passive investing, move to, companies that become the gorilla in the group. And of course, BlackRock is certainly there. Just maybe touch on BlackRock because certainly their themes continue to accelerate as well.
Yeah, certainly. So, BlackRock certainly is the gorilla of the group. They're the world's largest asset manager. They have about $7 trillion AUM. So their product line is so diversified that really flows into any asset class benefits them. We like them. They pay a good dividend. It yields about 2.5%, and they've grown that dividend 10% over the last 5 years. So even during these uncertain times, they have the balance sheet for it, and they've reiterated support for that dividend, which is nice to see. They have a ton
James,
of levers.
They've also won a big program from the Fed, haven't they, in some of the asset purchases?
Yeah, absolutely. So one of the key catalysts for us getting into BlackRock was that at the end of March, when the Federal Reserve released the terms of their secondary credit facility program, they announced that they're going to be stepping in and buying certain high yield bond ETFs to ensure that the shares of those ETFs don't trade at too significant a premium or discount to NAV, just to ensure proper functioning of high yield credit markets. So this represents potential for massive inflows into the HYG ETF, which is run by BlackRock. It's the biggest high yield bond ETF. And besides that, BlackRock is helping the Fed step into credit markets just because the Federal Reserve itself doesn't have the manpower. So
right.
Good opportunity there.
Right. So there's three names that we think structurally benefit going through what is happening. They were winning coming in. This shutdown will likely accelerate all three of their business models. And we think they are very, very large markets that they can continue to address. Pam, was there some other questions that we can answer?
Yeah, there's one specific question, if you wouldn't mind, and maybe James, you can provide us with your view on this as well. Could you make simple sense of the stimulus package and the main differences from your perspective between 2008 and 2020?
So from my perspective, and I'll just keep it pretty simple. I'm not sure anybody remembers the rant that Jim Cramer went on during 2008, where he talked about how the Fed knows nothing because they're doing too little, too late. And the one thing that I think that they learned coming out of the financial crisis was that the central banks have to act quickly, and the governments have to get their act together and act quickly. And so they were very quick to make sure that the market knew that they were going to make sure the market continued to function, and that there would be liquidity, and that companies would be able to get access to credit. The problem in the 1930s was that the government said, we're going to take a laissez-faire attitude, we're going to let the market take care of the market, And ultimately, way too many businesses went bankrupt, too many people lost their homes, the banking system imploded, and it took forever to come back. The unusual steps that they took in the financial crisis ultimately meant that we didn't wind up with a long, dragged-out depression. And in this case, they said very quickly, the most important thing is going to make sure that the system continues to function. And so not only did they come in with very, very large packages very quickly, and I think to date it's about $7 trillion, but they went after very specific areas of the economy that were most vulnerable, not just supporting big businesses. So they were supporting the consumer and their ability to live life. And I think those two things have made an enormous difference. And they have also gone on to say, if we need to do more, we'll do more. So what that says is to somebody who has a negative view of the world, it tells them they better be careful about being too negative because, as they say, don't fight the Fed.
So Dave, do you think that we will see a retest of March lows or not? Or is it too early to tell?
I think at this point we probably don't, but I do think that it would be highly, highly unusual for the market not to have some ups and downs as we work our way through the opening process. You know, we talked about the first lift was technical. The second lift was driven by the stimulus and driven by a slowdown in COVID cases. And this last few days is optimism that certain parts of the economy can reopen. And I think that's all great. So the market does have a tendency to look beyond problems. But I think there are very few people considering what it might mean if, like in some other parts of the world, they had to shut down a second time, or there's a second wave that comes before there's a therapeutic or a vaccine. You know, we do not live in a riskless world. The market is not that far, you know, sort of 15% off the highs or 13% off the highs for the year. I think that realistically, we will see some choppiness. So as we get beyond these earnings, you know, we watch very closely. As it is right now, the market is synthesizing information well. We're getting constructive behavior at the sector level, at the market level. So you can't fight that. But we watch very closely all of our individual positions and see if there is a market signal, because that's where it will come from. The market will show us that they're losing confidence, and that will mean that the most economically sensitive sectors would start to weaken against the defensive sectors. At this point, that's not the case. The last 3 days, in fact, it's the dead opposite.
Dave, companies, do you find that that typically pay out a dividend, do you find that they're reducing or eliminating quarterly dividends? And if so, what effect does that have on the Barometer pools and funds? And further, what kind of protective measures does the firm take to counter the loss of potential income that might be generated by the dividend growers that we have come to be so fond of?
Well, it's a great question, and that's something that I think that I'm very proud of our team on. I think that we are very good at assessing the risk in the balance sheet and the risk that dividends could get cut. We haven't had a dividend cut in our companies in 5 years. Now, the reason you want to make sure you don't have a company that cuts their dividend is that outside of the initial drop, it often takes as much as 18 to 24 months for the shares of a company to cut their dividend to sort of get back into gear. There's a lot of people who own them, they own them for the yield, and if the yield goes away, they say, you know, I'm going to become a seller. So I know that the team has a model that they run to assess the risk to the dividend. And I know that we have been especially focused on making sure that all of the companies that we own have very strong cash flow generation, a very strong financial position, and pretty predictable business models. So we own almost nothing that is dependent on the economy getting better right away, right? So there are people who will have home runs in stocks that are left for dead because if it goes on too long, they'll expire. That's not our type of investment. Our companies are companies that will continue to pay the dividends that they have really come hell or high water. And so I think it's unlikely we are going to see dividend cuts. And there will be benefit that flows to the companies that have the best ability to pay.
Dave, markets are up about 30% from their lows. How have Barometer funds and pools performed since that time?
So I saw that question came in. To the lows, the portfolios were down about half as much as the market. We definitely did not stomp on the gas off the lows. All of the portfolios, for the most part, are ahead of indices for the year. I think that the equity portfolio is maybe down 2 or 3% as of today. The long short portfolio is down 2 to 3%. I think the balanced portfolio is down sort of 5. Market as of today was down about 12 on the year. The TSX down a little bit more than that, 15, 16. So I'm pleased. I think that we've had low vol. We've had we're ahead. You know, I think that all the portfolios are different and set up differently. Right? We have a couple of portfolios that have been set up to be more defensive. If we have a big drawdown, we have some that are set up more offensively in the sectors that are leading, like the equity portfolio, for instance. But in general, I'm pleased with where we sit from a volatility standpoint and from a return standpoint.
Dave, I think just in the interest of time, maybe you could just provide us with your last thoughts, and then we'll wrap up this webinar and have everyone join us again next Wednesday. Any last thoughts?
I think the most important thing going forward is going to be watching how the market reacts to news. Trying to predict what date the economy is going to reopen, or trying to predict, you know, when we're going to have a vaccine is not going to be fruitful for us from an investment standpoint. The best way to assess the health of a market is how it manages news. And, you know, we've had several really negative economic data points in the last week. We've had a ton of companies say they are pulling their guidance for the rest of the year, but the market is focusing on the good news right now. And so that is something that we watch, and I think our breadth models are good at watching and will continue to assess. You know, I hate risk like anybody else. We cannot be risk-less. So we just got to make sure that our themes continue to work and that the companies that we own within them will continue to execute the way that they have done so far. And just take it day by day. And as the other slide said, you know, we can trim our sails accordingly.
Well, thanks so much, Dave, for your time. Thanks, James, for joining us. And thank you to our investors and prospective clients. We really appreciate you taking the time to tune in this afternoon. We look forward to seeing you back here next Wednesday at 4 p.m. and we'll send out the details for our next call next week. If you have any questions that weren't addressed in this webinar, we will be happy to follow up with you after the call. And again, thank you so much and stay safe, everyone.
Have a great day.